Welcome to today's episode. Today we are looking at a concept related to psychology of money. Why do you spend money the way you do? And inside this video, we'll go ahead and explain 5 money personalities that determine how we spend, how we save, how we invest whatever money that we want to do. Because most people think that money and financial problems come from lack of income, from lack of finance. But the truth, what I've come to learn over time and from the knowledge from the books such as Psychology of Money, is that how you spend money and money problems comes from one thing: your money personalities. So that you don't spend money, you don't save money, or you don't make financial decisions on a random basis randomly. You do it because of who you are, because of how you think, because of how you were shaped, um, how the history where you've come from has shaped you. So in this video, I will break down the 5 key money personalities, how to identify yours, and how each of those personality affects your ability to build wealth, and to change your financial, how you view finances. And before we go deeper into this, the first step of financial freedom or understanding your finances is understanding your money personality. And just before we begin, there is a quote in the Psychology of Money, and I just want us to look at it, even as we before we start looking at the 5 money personality types. And this is the quote: engineers can determine the cause of a bridge collapse because there's an agreement that if a certain amount of force is applied to a certain area, the area will break. Physics isn't controversial, it is guided by laws. But finance is different. It's guided by people's behavior. And how I behave might make sense to me, but look crazy to you. The more I studied and wrote about the financial crisis, that is Morgan Housel speaking, the more I realized that you could understand it better through the lenses of psychology and history and not finance. To grasp why people bury themselves in debt, you don't need to study and understand interest rates. You need to study the history of greed and insecurity and optimism. To get why investors sell out at the bottom of bear market, you don't need to study the math of expected future returns. You need to think about the agony of looking at your family and wondering if your investments are imperiling their future. So at the end of the day, how you make financial decisions is not based on whether there is luck or whether there is abundance, but on money personalities, on financial personalities. We'll also refer to another concept from this book in a short while. So let's get started with the 5 money personalities. So these are dominant personalities, their characteristics or features, and how they affect your financial life. Personality number 1 is the spender. And who is the spender? This is the person who loves buying new things. This is the person who gains emotional satisfaction from spending money. The person who is impulsive. Anytime they see something they want to purchase, they are impulsive in nature, and they often buy without planning. This person sees money as a tool for enjoyment. And how does this affect money? This this often leads to that person living paycheck to paycheck. That person will struggle. If you're a spender, you'll struggle saving. If you're a spender, you experience debt cycle. You finish paying one debt, you start paying another debt, then you also take another debt. These are the people who you might find a series of lending apps in their mobile phones. But when disciplined, with discipline, this person can enjoy life fully and reward themselves meaningfully. So that is a spender. And so you can gauge yourself as we are going through the characteristics of all these money personality types. Gauge yourselves where you are. Many a times there's an overlap. You can find some characteristics in a spender and you find them in a saver. So let's look at money personality type number 2, and this one is the saver. As the name suggests, these people are more inclined to saving as compared to the first type, investing. So this person is constantly saving. Whenever money comes in, whenever they are paid, whenever they get a gig, they are more inclined to saving as compared to spending. So constantly saving, they hate unnecessary spending. This is a group, the category of people who finds comfort in watching money grow. They'll put some money somewhere in a money market fund, in a savings account, and they find comfort in watching that money grow over a long period of time. These people are risk averse and they're very cautious with their money. How does this affect money? These people will rarely go broke. These people will build security quickly, financial security quickly. But there's a but. These people, there's a fear of risk. The fear of risk, because these people fear risk because they are saver. Because of the fear of the risk, these people can limit investment growth because they are not risk takers. They want to save money. They want to keep money around them and just watch that money grow slowly. So they are not people who are free to invest that particular money. They can save, yes, but they won't invest that money. So what does this imply? It means that these people can miss opportunities due to being over cautious. Remember, investing money involves risk taking. So if you find someone who is not willing to take a risk, and then it shows that they can miss opportunities that would have gotten as a result of investing that money in a high yielding investment vehicle. Then personality type number 3 from money, we have got the investor. Now, who is the investor? As the name suggests, these are people who are future oriented. What does it mean? That they love opportunities. They think in terms of returns. Anytime they have got a shilling, a dollar, 10,000, they are always thinking in terms of returns. How much can this amount of money give me in future? If I invest this money in this investment vehicle, how are the returns likely to look like? So they are more focused on returns. And this implies that these people will engage in calculated risks. Whenever there's an opportunity for them to invest, they are always doing the math. Like what is the return in this particular vehicle? Like how much will a SACCO give me? How much will the government bonds give me? How much will this bank give me? How much will this special funds give me? So they're always engaged, their mind is always engaged in calculated risks in future. How does this affect money in the long run? This is someone who will build long-term wealth because they're always thinking about the future. And this is someone also who understands delayed gratification. They understand that they would rather not spend money now, but have that money accumulated so that in future it can have a higher returns. That basically explains delayed gratification. Your ability to delay the needs or to delay the gratification that money would give you now for the purpose of you getting higher returns in the future. However, these people can lose money through overconfidence or poor research. Because you have to understand the mind of an investor. An investor is someone who is thinking from the future. When you give them 10,000, they're thinking about how can this 10,000 give me 20? How can it give me 30? How can it give me 50? 2 years, 3 years to come, or even 1 month to come, which means that they're because their mind is thinking about the returns, they are likely to make financial decisions because of that overconfidence and because of poor research. Because, as I've said, they are constantly thinking about tomorrow and they're thinking about the future and the returns that they are likely to get from the particular deal. Personality type number 4 is the avoider. Avoidance. Characteristics. This is the person who hates thinking about money. They, in their mind, they don't want to imagine. They don't want to imagine that you can sit somewhere and just think about money. So they don't want to think about money. This is the group of people who avoids budgeting, avoids bills, avoids bank statements, and they don't even want to look at it. These people get stressed about financial decisions. These people, they let others take control of the money. Even in a family setup, this is the husband or the wife who will want the other party, the other partner, to take control of the money. They don't want anything to do with money. They avoid money at all cost. Now, how does this affect money? These people, this group of people, are the group of people who can easily fall into debt because in their mind they don't want anything to do with figures, with finances, with whatever money is in the account. So they can spend more and this will lead them into falling into debt. Number 2, financial problems accumulate because their inability to think about money, their inability to have money conversation, their inability to comprehend where money is coming from and where money is going, how bills are being paid, can lead these people into financial problems, into financial challenges. And so problems will pile. And this is where you, at the end of the year or at the end of a quarter, you realize that you have made a lot of financial problems and you are so much deep into them. And you have to be aware that these people, avoidance delays growth. Anytime you don't have conversation about money, anytime you avoid conversations about a particular thing, it delays growth in that particular aspect. But awareness alone can shift their growth curve dramatically. If you just have the awareness, the understanding that I am an avoider, this will dramatically shift your perception. This will dramatically shift their growth curve in a positive way. The last category of money personality is the status seeker. What are the features of this person? What are the characteristics of this person? This person is those people who uses money to signal success. You will see, you will understand. There are those sayings online. There are those cliches that normally say that, like, when I get $1 million, I will not tell anyone, but there will be signs. So this is where the status seeker fall. Like, you'll see signs. You'll see another car, a brand newer car, which they won't drive for 2 months. You'll see potentially a new house, depending on the kind of how much money they get. You will see a nicer phone. You'll see a nicer laptop. You'll see different vacations. And as they're doing that, they do that in public. We can call this, we have public display of affection, but this one now we can call it public display of money or public display of wealth, because to them, money signals success, and the people have to see, the world has to see that they have got that particular success. So they'll buy cars, they'll buy outfits, they'll buy clothes, they'll go to Dubai, they'll go to Seychelles, and they will make sure that you have seen that they have gone to those particular countries. These people, they get validation from how others see them. They enjoy appearing successful even before becoming successful. And now, how does this affect money? High risk of lifestyle inflation. We've talked about lifestyle inflation on this channel. Your money, anytime you have got your money, your income rises, your expenditure also rises to meet your income. So that instead of you having more money to save, you actually keep spending more money as it comes. These people, they are easily trapped in debt because of the need to show, the need to spend. So they can easily be trapped in debt. And so strong motivation to make money, but often misused. These people will have the desire, the need, the urge to keep making more money, but at the end of the day, they misuse this money, they spend this money because in their eyes and in their mind, people's eyes are on them, and they want to spend this money so that people can see. They want to spend this money on vacation, on new outfits, on new places, on new car, on new neighborhood, and so many stuff. This is someone who, the moment their salary can increase with a small amount, but they'll want to move to a higher palatial residence just to show people that, you see, I belong to this particular class. When disciplined, these people, the status seeker, they can leverage image to open doors and opportunities. They say that image is everything. And like when I see you with a particular car, for example, when I see you with the Porsche Cayenne, when I see you with a Mercedes Benz S-Class, with a Maybach, there's a way I will perceive you. If I'm going to sign a particular deal and I check in with a Maybach, I'm more perceived to be given the opportunity as compared to another person who checks in with the maybe another car, which I won't mention. So when disciplined and when you learn to leverage this, the image that you create can open doors, and they can open opportunities to serve you well. An important part of this video is, how do we acquire these money personalities? So money personalities, we don't wake up one day and say that I want to be a spender, I want to be a saver, I want to be a status seeker, or I want to be an avoider. No, your money personality was shaped long way before you earn your first dollar, before you earn your first shilling. The environment that we live in, that you are raised in, essentially dictates your money personality. And before, there are 4 major influence factors that affect how we spend money, that determine our money personality. And before I look at it, there is no one is crazy. The first chapter of The Psychology of Money by Morgan Housel. Just let us go through it. Let me tell you about a problem. It might make you feel better about what you do with your money and less judgmental about what people do with their money. People do crazy things with money, but no one is crazy. Here's the thing: people from different generations, raised by different parents, who earn different incomes and held different values in different parts of the world, born into different economies, experience different job markets with different incentives and different degrees of luck, learn very different lessons. So as we're going to look at how our money personalities are shaped, is paramount to understand that people raised in different environments by different parents and just also living in different geographical environments, these people learn money differently. If I was raised in an urban township or town, another person is raised in a rural location, how we perceive money, me and that person, will be very different. The interesting bit, Everyone has their own unique experience with how the world works and how money works. I've added that part. And what you've experienced is more compelling than what you learn secondhand. Morgan says that how you've grown in money or how you've grown in an environment without money is more important than the lessons that you learn when you have money. So all of us, you and me, everyone, go through life anchored to a set of views about how money works that vary widely from person to person. So what seems crazy to you might make sense to me. And like no one is crazy. When you see someone overspending money, or when you see someone who is a spender and someone who is a saver, they're not crazy. It's because of how the environment has nurtured them, how they have grown, the background where they have grown, how it has nurtured them. Look here. The person who grew up in poverty thinks about risk and reward in ways that the child of a wealthy banker cannot fathom even if he tried. I'll break that one down. The person who grew up when inflation was high experienced something this a person who grew up with stable prices never had to do. The stockbroker who lost everything during the Great Depression experienced something the tech worker basking in the glory of the late 1990s can never imagine. The Australian who hasn't seen a recession in 30 years has experienced something no American has ever experienced, and so on and so on. There are so many. You know stuff about money that I don't know. You've gone through money lessons that I haven't gone through. So how you spend money and how you handle money is to you a tell, is to you something that only you understand. So with that, we understand the four major influences how we acquire money personalities. And the first one is the family background. The way money was handled in your home becomes your default setting, becomes a blueprint on how you handle money, becomes a guideline on how you handle money. If your parents fought about money, you become an avoider, you avoid finances. If money was spent freely, you become a spender because that is the only lesson that you know. If money was scarce, you become overly cautious or compulsive or a compulsive saver. Because when you are growing up, money was not easily available, it was scarce. So children just don't watch, they absorb what they go through. Influence number two is the environment, and this includes the community and the culture. When you grow up, where you grow up shapes your beliefs, shapes your perceptions, shapes your understanding of money. There are communities that glorify consumption. People who just keep consuming. They produce status seekers. Areas with scarcity, if you grew up in a scarcity without money, it produces savers and avoiders. Cultures that value entrepreneurship produces investors. So your surrounding normalize certain financial behaviors. Category number three, the factor number three is the exposure. The exposure, this can also be the environment, the people that you interact with at different levels. So what you see and learn over time. Your money personality shifts or changes based on the following: your mentors, the content that you consume, the financial books that you read, the courses that you take, the peers that you spend your time with, and the workplace culture. That is why it's very important for you to keep reading financial books, keep listening to financial podcasts, subscribing to channels that talk about money, because the exposure that you have about money will determine your money culture. And at the end of the day, the exposure is like it's the you don't fall because of lack of knowledge. You will rise to the level of the exposure. You rise to the level of the books that you have read, to the mentors that you have, to the courses that you've studied about money and about finances. And so the exposure will either expand or limit your money mindset. Finally, your personal experiences, and these are wins and wins or failures. Your past money history or your past finance history will create your future patterns. Trauma in the past can create avoidance in future. Debt cycles constantly can create fear about money because you have gone through debt and you understand how debt feels. So the only lesson that you have learned through debt is fear. Early success in life can create confidence or overconfidence. And then losing money can, if you've ever lost money in the past, it can shift you from being risky to being more cautious about money. So your experiences don't define you, but they actually shape who you are financially. The other section that we shall look at is that why does this matter? Why is it important for you to understand money personalities? Because you cannot change what you don't understand. There's a saying that says what can be measured can be changed, something close to that. When you identify your money personalities, three important things happen. The first one, you understand your triggers. You understand what makes you to spend money, what makes you to save money, what makes you to invest money. So you're able to understand your trigger. Number two, you correct negative patterns. The reason why you understand our personalities is so that with the knowledge that we have, you can correct negative patterns and embrace the positive patterns, multiply them. And I've said, so that you understand your money triggers, you correct negative patterns, you enforce positive patterns and behaviors, and number three, you accelerate wealth building with intentional money habits. Because ultimately, at the end of the day, whether you like it or not, your money personality will control your money. And until you learn how to control your personalities, you never control money. It doesn't matter whether I give you 10 million, it doesn't matter whether I give you 1 shilling, it doesn't matter whether I give you 1 billion. When you don't understand your money personality, the amount of money that you earn doesn't matter, because you'll either spend that money, you'll avoid that money, you will save that money, or you will use that money to build status, the the status seekers. So when you want to change your financial trajectory, how you think about money, how you talk about money, how you interact with money, the first step is always understanding money personality. Because at the end of the day, your money personality is the driver behind the wheel. You are not the person who makes those decisions, it's the personality in you that makes those financial decisions. So those are the 5 money personalities, and we shall go deeper into this. We shall go much deeper into psychology of money, why we spend, how we spend, the art of spending money, how children should learn about money, so that when they grow up, they are molded into different personalities, and how parents can also make different decisions, so that when the children are growing up, they know about these different money personalities. So let me know which one describes you as an individual, what you have learned, and which money personality describes you personally. And if you find this video helpful, as I always say, give it a thumbs up, and I'll see you in the next video. Bye.